Hello and welcome to your Daily 5 for the 16th of June. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. And today it is my turn to host this episode of your Daily 5 again. I am a senior analyst here at StockCharts.com and the creator of relative rotation graphs. And of course, they play a crucial part in my approach to pick 5 interesting charts for you. You can find my contributions in the RRG blog on the site, as well as on StockCharts television, where I host Sector Spotlight every Tuesday from 10:30 to 11 a.m. Eastern. I want to start the journey for today's 5 charts with a relative rotation graph showing asset classes, showing the rotation of asset classes against a balanced index fund, which is the benchmark VBINX. And the main theme here, there's a few. I think the one that I want to tackle first is the strength of the US dollar. I think that is still a very important theme in the market that we need to address. And the second observation, the second theme that we can take from this chart is the still risk-off constellation. If you look at the tails for SPY and VNQ, you can see that they are traveling at a negative RRG heading. SPY is already inside the lagging quadrant and VNQ is inside weakening, but rapidly moving towards the lagging quadrant. And if you look at the risk-off asset classes, which is all fixed income related, then you will find corporate bonds inside improving, government bonds and high yield already inside leading, which means that they are outperforming the balanced benchmark. Let's move to the first chart for this series, and that's the euro dollar chart. Those of you who follow Sector Spotlight every week, you've seen this chart before, but I think it is once again very important because we have completed a peak, a top formation against resistance around 108, and it was the area that is coming from the falling trend line that connects the peaks since February, as well as the horizontal level around 108, which is the lows that were formed in March and in April. And then again, it came back as resistance very recently at the end of May and in the month of June. We had a slight sideways movement, and then a couple of days ago, we broke below 106, and we accelerated lower, and we are currently testing support around 103. If that gives way, then there will be much more weakness for the euro and strength for the dollar. The next relative rotation graph that I want to show you is the one that shows the rotation for the various maturities on the yield curve. These are all ETFs, so these are all price-based. TLT, TLH, IEF, those are the longer dated Treasury bonds, and then we've got IEI, SHI, and BIL, which represent the shorter end of the curve. Basically, what you see here is the rotation of the yield curves, the movement of the yield curve. And the main takeaway here is that the longer dated maturities are moving up in price. By the way, this is all relative. So they're picking up relative strength, while the shorter dated maturities are losing relative strength. And that is a transition. And what it means is that the yield curve is flattening. The longer end, yields at the longer end are coming down, yields at the shorter end are going up. And that means the yield curve is flattening. And at the moment, we're in a situation where every now and then the yield curve is inverting. And I'm going to show you that chart in a minute. First, let's start with the 10-year yields, because I think that is an interesting chart. If you look at this long-term chart, this is a monthly chart. Of course, the month of June is not completed yet, but this is the only way I can show you so much history and the significance of the recent rise in 10-year yields. we are breaking a very significant downtrend, and it is coinciding with a break above horizontal resistance, which was just above 3% in 10-year yields. So I'm going to take this as a very serious signal. I think that yields and 10-year yields are turning around a very long-term downtrend. And it's very unlikely that we're going to see a massive decline, a sharp decline in these rates anytime soon. And if we quickly move over to the 2-year yields, you'll see that it is even worse, probably is the better word. We're turning around a 20, 30-year downtrend, maybe even longer. You can see that I've drawn my declining trend line over subsequent peaks, not necessarily from the highest peak, but from the most recent major subsequent peaks. And then we're also breaking out of this massive base here that started in 08 and is now completed. If you put price targets, if you want to put price targets on these charts, then you would be looking at 3%, like almost a doubling of current 2-year yields. Let's peg it for the time being around 5%. That's the high that we saw in 2006. But there is magnificent upside, significant upside for 2-year yields and 10-year yields. Now, what does that mean for the yield curve? If you look at the yield curve, we are flirting with inversions every now and then. And that is usually a situation that is not good for stocks. It usually precedes a recession and a more serious decline in the stock market. I have highlighted a few of those events in the past, and you can see that the market every time goes through more or less a more significant or less significant decline for quite some time. So that's what we're seeing right now, and I believe that we need a little bit more downside to respect that yield curve inversion and potentially the recession that we're going into. If we quickly move to SPY, then again, you can see this is the daily chart, so this is a little bit shorter term, but we have those gaps and we broke below the previous low a few days ago. And today with the Fed announcement, which was taken as a positive, I guess, from reading from the market, it wasn't even able to close the gap, nor was it able to close back above its former low. So this downtrend is fully intact. And then to end up with a positive note, we have I want to show you the relative rotation graph that shows you the members of the technology sector against $1. So this is all price based, and you can see that there is one stock, IBM, that's positioned inside the leading quadrant. This sector is massively going down. It's a massive downtrend. Look at the individual stocks. If you pick out IBM, you'll be pleasantly surprised. It's not a super strong uptrend, but it's holding up very well, where all the other tech stocks are dropping like a stone. If IBM is able to take out these overhead resistance levels around 145 and 157.5, I think there is upside for IBM to be gained, and definitely on a relative basis, IBM is the strongest stock inside the technology sector. And that concludes your Daily 5 for today. Thank you for watching. I hope you enjoyed the presentation. I'm looking forward to see you again at a future episode of your Daily 5 very, very soon.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.